Hey everyone, so in this video, I'm gonna look at the shareholder letter that Amazon CEO Andy Jassy sent out just a couple of a week or so ago, and try and decipher, what was in this report that has so many people talking about Amazon stock. Of course, Amazon stock is down significantly off its highs, and investors and shareholders are wondering when this company can turn itself around, when it can return to a higher and increasing stock price. So let's go through this shareholder report and let's try and figure out what we like about it and why people are talking about it. So I've already gone through and I've highlighted some of the key things that I noticed. And so starting with over the last several months, we took a deep look across the company business by business. In some cases, it led us to shutter certain businesses. For instance, we stopped pursuing physical store concepts like our bookstores and four-star stores. We closed Amazon Fabric and Amazon Care and moved on from some newer devices where we didn't see a path to meaningful returns. So, okay, that's interesting that they chose to shut down these departments and new products and innovations. And Amazon's that's in Amazon's DNA, sort of developing these new technologies, these new products, these new services, trying it out. And if they fail and if they're not working as they thought, Amazon shuts it down. They're not afraid to try new things, and if they work, great, and if they don't, they shut them down. This is what Amazon has been doing for decades. And so we like, as investors and shareholders, we like when companies do this. I like that Amazon does this, and I like that they're quick to shut things down when they're not working. I like that in management teams that they're not afraid to say, you know what, we tried this, it didn't work, and we're shutting it down. I like that the company, the team has that capability where they're not afraid to say, we tried this thing and it didn't work. Right? Because a lot of companies, they do have that fear in like, oh my God, what are our shareholders, what are our investors going to think if we tell them that we tried this thing and it didn't work? We don't want them to think that we spent all this money on this thing and it didn't work. And so try to force it. They try to really push it, double down efforts when they, really can tell early on with their internal data that this whatever project is not going to work out. They really try to force it instead of just saying, you know what, all right, let's move on. So Amazon has the confidence, the courage to do that, and I like that. Another thing that was long, well, I shouldn't say long, but another thing that was overdue is these job cuts. We also prioritized where to spend our resources, which ultimately led to the hard decision to eliminate 27,000 corporate roles. So, you know, Amazon added a lot of workers in the last few years. A lot of workers. They went from like 800,000 employees up to 1.6 million employees in the short time frame from the result of the outbreak. And so they overhired, they overinvested, and now they need to pull that back. I'm glad they started with this, but I think this should just be a beginning. I'm hoping there's more job cuts and cost cuts coming from Amazon. We also looked hard at how we're working together as a team and asked our corporate employees to come back to the office at least 3 days a week, beginning in May. We've become convinced that collaborating and inventing is easier and more effective when we're working together and learning from one another in person. Really? Really? I'm not so sure about this. And even if that's the case, right? Even if okay, it's the case that if we all come together in person, our output is going to be better because we're working together and we overhear something, we maybe have some spontaneous collaboration and all of that. Okay, I'll give you that. However, is that benefit, that increase in output, worth all of the extra cost to have people come into the office, right? You've got to pay for real estate, you've got to pay for the office, you've got to pay for uh, maintaining the facility, you've got to pay for the computers, the software, all of that, the upgrades in that, and then you've got to pay people more, right? Or you're going to have a harder time attracting employees because employees, it's clear across the board, several surveys, several people, and after you could look at the backlash that Amazon got after making this announcement from Amazon employees, saying, "Hey, we don't want to come back to the office." All of that, all of those costs, is that increase in output enough to justify the flip side of it, all of the extra cost associated with bringing people back to the office? I don't know. That remains to be seen, and I'm skeptical that the output is that much better, right? I'm skeptical that the output, some magical synchronization of having people working in the same place, is going to create some, 1 plus 1 equals 3 kind of math. And on the other side, for sure, your costs are increasing when you're bringing people back to the office. That's certain, 100% certain. Costs are going up, and then the output increasing. That's a lot more uncertain. That's a lot more unpredictable. And I don't know. I don't like this decision from Amazon. And I'm not an Amazon shareholder, and decisions like this turn me off from becoming an Amazon shareholder. When I see this, when I see you have an opportunity to save on costs by, having less office space, to increase your ability to attract employees, right? You don't have to be in a certain area to hire people when you're hiring them remotely, and you're going to be able to pay less when you're allowing people to work remotely because it's just more convenient, and people are going to be willing to work for less because they don't have to spend that time and money commuting. And so when you're making these kinds of decisions as an investor, I'm saying, you're missing out on an opportunity. I'm not happy with that, and I'm going to uh, keep my investment, and I'll wait and see. If you prove me wrong, let's say 3 years from now, you prove me wrong, and we can compare Amazon with another company or other companies that chose to remain completely remote, and Amazon didn't remain remote, and then 3 years from now, their employees are more productive, and we can measure that by looking at financial metrics like revenue per employee and other metrics like that. If Amazon can prove over the next 3 to 5 years that they're outperforming these companies that chose to remain completely remote, okay, then I'll reverse my skepticism and I'll say, you know what? Okay, you were right. I was wrong. Um, the remote working versus working in office was a bigger benefit than I thought, and I'll stand corrected and I'll reverse my investment decisions. But for now, I'm looking at companies that choose to not take this opportunity to reduce their office expense and increase their ability to attract employees across the world at lower costs. I'm looking at that as an opportunity that I'm hoping they capitalize on, and when they don't, I'm looking at that as a negative. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So the next thing they discuss is we've made several changes that we believe will meaningfully improve our fulfillment costs and speed of delivery. And the CEO highlights we had to double the fulfillment center footprint that we'd built over the prior 25 years and substantially accelerate building a last mile transportation network that's now the size of UPS. And they really did. Right after the outbreak, Amazon has spent nearly $200 billion in capital investment to expand their fulfillment network and logistics. It was a huge investment and over it's proving to be an overinvestment. And these are long-lasting investments, right? When they build a warehouse, when they spend millions of dollars building warehouses, they can't get that money back, right? There isn't another company at the scale of Amazon where they can say, okay, why don't you guys buy out our warehouse network? Why don't you guys buy these 500 warehouses that we built, right? There aren't very many companies in the world that can buy Amazon's warehouses so that they can divest from that investment. And so their management is stuck with just saying, hey, you know what? We're going to need to just learn how to use these fulfillment and logistic services better, and we're just going to have to grow into them, right? So we've got all this capacity. Our revenue is like here. So as we grow, we're not going to need to spend more on warehouses and logistics for a long time because we already overinvested during the early stages in the pandemic. So if they continue growing and learning how to better use all their facilities, that could bring them to better profitable operations. So last year we started re-architecting our inventory placement strategy, leveraging a larger fulfillment center footprint to move from national to regional network, made significant changes to create 8 interconnected regions in smaller geographic areas. Okay, this all sounds wonderful, making it seem like they did all these improvements that are um, going to be good for the company. But this is they've become Amazon for me has become a company that needs to demonstrate. They need to show me. They need to show it in their financial statement. I'm, this all sounds great, but I need to see it in the numbers. I need to see your fulfillment expense as a percentage of your revenue actually declining. I need to see your profit margins expanding. I need to see your employee count decreasing as a result of being able to better use your logistic facilities, as a result of being able to get more production out of each employee. I need to see these things. And for the most part, we were seeing that before the outbreak. And then after COVID, and this isn't to say that management is not competent, but the pandemic was an extremely difficult thing to manage. Not very many companies got it right. Not very many companies got it right. To see your business go from, like Amazon was, I think, at around 300 billion in sales before the outbreak, and then jump to 400 billion, to increase your sales by $100 billion in 1 year is not an easy thing to do, especially when most of that increase is due to sales of products rather than sales of services. Sales of services, yeah, it's easier to scale up, but sales of products, shipping, handling, delivery, all of that, that's much harder to manage. And so, Amazon hasn't done a great job of that from an investor perspective. From a customer's perspective, they did a really good job, right? They were reliable. They were able to deliver fast and free shipping across the pandemic with little hiccups. From customer perspective, they did really good. From an investor perspective, they did not, because they chose to make sure that the customers had a really good experience. So they said, you know what, if we're going to make a mistake, let's make a mistake erroring on the overinvestment rather than underinvestment. Now they go into discussing AWS, which has an $85 billion annualized revenue run rate. It's still in its early adoption curve, but at a juncture where it's critical to stay focused on what matters. AWS faces short-term headwinds right now as companies are being more cautious in spending given the challenging current macroeconomic conditions. Right. So, other companies have realized that, what? Investors are becoming less tolerant of unprofitable growth, and investors are focusing more on growth, on profits now. So let's try and cut back costs wherever we can. One of the areas they're cutting back on costs is on cloud computing, and unfortunately that's where Amazon's profits are generated from, right? If we take out Amazon, if we take out AWS from Amazon, the company's not profitable. Company's not profitable. It loses money in the e-commerce business, North America International. Where it makes its profits is in this AWS, right? AWS has a very healthy operating profit margin near 30%. This is where Amazon makes its profits, and to see companies pulling back their spending here is hurtful for Amazon. So I'm going to finish with the CEO's closing statement saying, while we have a consumer business that's $434 billion in 2022, the vast majority of total market segment share in global retail still resides in physical stores. That's right. We still, even though we might think in the that uh, people spend a lot of money online, still only 20% of global sales are done online. So there's a lot of room for growth there. And then similar story to to the AWS business, global IT spending, where AWS achieved revenue of $80 billion in 2022. Still 90% of global IT spending is still on premise and has yet to migrate to the cloud. So even though AWS is already at $80 billion, there's still a lot of runway to go because 90% of global IT spending is still done on premises. So that moving to the cloud is going to be a tailwind for Amazon. So I think that sums up Amazon's uh, stock prospects really well there in this shareholder letter. Is that near term, we've got a lot of difficulty. We've got a lot of trouble. We overinvested during the pandemic. Now our costs are really high, and we're trying to work on growing into that to improve profit margins, right? So near term, very challenging, and that's reflected in the decreasing stock price down significantly off its high. Longer term, however, we've got really good prospects, really good prospects. We're one of, if not the most dominant company in a segment that's got strong tailwinds long term, and we're also the dominant company in the global IT area, where we've got strong tailwinds from the shift in spending, right? So they've got strong tailwinds in the long run, where the the money is coming to them longer term, right? The money is coming to their industry longer term, and they're in a great position to capture that growth, in the long term. But in the near term is where their troubles are. In the near term, right now, they've kind of gotten a bit ahead of themselves in investing in where the revenue is coming. And so for the near term, profits are going to be hurting. So I think that sums it up really well for Amazon. Long term, excellent prospects. Near term, not so good. And that's really the story, is how quickly can management, reduce those costs wherever they can, whatever discretionary areas they can, to bring profits up and get them in a better position to wait for the market to come to them as these industries grow, and as enterprise spending and consumer spending works in its favor. All right, so that's all I've got for this video. Thank you so much for watching. I really appreciate it. You've spent a lot of time with me watching this video. You could have been doing a lot of other things. I sincerely appreciate it. Thank you so much, and I'll hope you join me again for another one of my videos.